Could we have another crash that rivals 1929?
Stay tuned to find out. All right, get on with it.
All right, everybody, welcome back to our latest episode of Bugle Notes. I'm Stephen Weitzel, joined by my partners Michael Bennicelli and Chad Smith, and today is the second part of our series where we're talking about, are we in an AI bubble? That was our conversation last time. And today we are examining one of the largest market bubbles and crashes in U.S. history, and that is the crash of 1929 that's been recently documented by Andrew Ross Sorkin in his latest book, 1929. And so today we're going to be talking about what the environment was like leading into the buildup and the crash of 1929. What are the similarities between today's market and the excesses we saw going into that? What are the differences? Could something like this happen again? So let's begin. Let's talk a little bit about what was the environment going into the 29 crash.
Yeah, so I took some notes as I was reading through the book. Actually went and did a little bit of research on my own. And
thank you for that.
Yeah, well, there you go. What I guess one thing that I found incredibly interesting was the state of the banking system at the time was very different than it is today, and I think it's helpful to understand that. And Andrew paints a great picture of what it looked like at the time during his throughout the book. But I went back and looked. 1863, 1864 was when the National Bank Acts were passed. And that was really the creation of one currency within the United States, and that essentially created the modern banking system. And so, up until then, banks were kind of few and far between, but once those acts were passed, the number of banks in the country really started to ramp up.
Yeah.
You get into the early 1900s, and that just goes vertical really right up into the crash. And so, by 1929, there were 30,000 banks in the United States, as opposed to today where there's probably about 4,500. Directly after the crash, that 30,000 number was probably half of what it was. So the banking system, to me, it was really interesting in how it was set up, and that it was totally fragmented. Across the United States, there wasn't a network necessarily of banks. There were a lot of small banks. There weren't very large ones.
There were no national banks.
Yeah, I mean, very few.
Everything was state chartered.
Right. And essentially the banks themselves a lot of them were really on the verge of insolvency even before you got to the crash, because they were regionally focused. They could be very specific to a bank focused on corn farmers in a particular state, and one bad crop could wipe them out. So the state of that whole network I found to be incredibly interesting, and that very different than what you would expect today in a very stable banking environment. So that's one thing that struck me for sure.
But leading into it, right, you had the roaring 20s. And so a lot of technological innovation, right? The radio was this new thing that was really taking off. It was connecting the world in ways that it had never been connected before. You had automobiles that were coming off of Henry Ford's assembly line. There were installment loans available for people to be able to buy things that previously they would not have been able to afford. Mm-hmm. And so the 20s were a period of abundance by and large.
So it was a state of credit too. So, one thing that again struck me as I was reading through the book is that credit was one of those things that was really new early in the turn of the century, and people were using it for everyday goods in a lot of ways. You buy a car or whatever on credit. But then it started to creep into the financial markets and really became a thing that was pervasive. So, the credit was one of those things that was very new to people. It wasn't as pervasive as it is today in terms of banks, knowing how to price things and knowing who they can extend credit to. And so, but it was something that Americans were, happy to go out and utilize.
Well, and so, with the backdrop of how strong the economy was, and this expansion that was going on, which was being sustained by a lot of strong fundamentals, right? Innovation, like you mentioned, and burgeoning industries, and of course, just a stable kind of world trade kind of environment as well. So it was not just in the U.S., but it was also in Europe. But with that, and then all of a sudden the advent of credit, all of a sudden it was like the sky's the limit, right? Everything is just completely unlimited, right? We can sell as many cars and washing machines and whatever. And so the mindset that this is an incredible innovation in of itself, the use of credit to allow people to go, live well beyond their means, essentially, that began to creep into the financial markets or the financial system. And then all of a sudden, a lot of the banks and just the financiers of the day were like, well, if you can expand the horizons of selling cars, you can expand the horizons of people buying stocks, and that'll just continue to help drive this whole thing, which was everybody became fascinated.
There was a lot of things that were untouchable for the average person, back in the day. But the idea of buying a house, right? And then when you were able to begin to do that on credit, it became a drug of sorts where people were, what's out there? What else can I afford, right?
To that end, so actually I wrote down this quote from early in the book where when we're setting the stage for the environment that we're in, where, again, we're at the end of the roaring 20s. Things have been good for a while, but he says that you have these lengthy, uninterrupted booms that produce a collective delusion. Optimism becomes a drug or a religion, and some combination of both. But people lose their ability to calculate risk and distinguish between good ideas and bad ones.
Yeah.
And, again, we're talking about if we had been in that period of time and we had seen lifestyles and the standards of living improve dramatically from the early 1920s through the late 1920s. And when things are good every day for so long that you become accustomed to the fact that that's just the way that it is.
Right.
Yeah.
And you anticipate that that's just the way that it's going to be.
Yeah. And I think that's, another theme leading up into the crash was just the rampant speculation. And I think that's, what leads into that is the optimism turns into there's no way to lose money doing this. And then that turns into people gambling essentially. And so, the things that support that idea of this rampant speculation, there were, speculative investment pools that were being created. You could go into any hotel and there would be a brokerage house there where you could place a trade if you wanted to.
And
you mentioned the
cruise ships as well.
The one on a boat where I don't know what price discovery is like in the middle of the Atlantic Ocean, but
it's slow. It's slow.
So people quit their jobs to be stock market watchers just because it was this crazy speculative environment.
Yep. That's right.
The OG day traders.
There you go.
Yeah. Well, and it was what was interesting was initially it were the power players, right? It was more of the concentration within New York.
Right.
And Wall Street became what it became. It had already been well established for several decades, but it became the epicenter, and it was everybody was in awe of Wall Street and these big bankers. We in the book talk so much about some of the key players like Charles Mitchell and Lamont and all the people involved in J.P. Morgan and National City Bank and all these other big banks that were dominant players, and they were all doing business with and connected with all the big industrialists around the country who were effectively the similarity to today's billionaires.
Yeah.
So they were all not only running their businesses, but they all started really getting enthralled with investing in the markets, and it was going really well, and they were making tons of money and getting richer and richer and richer. And they were, of course, as they did that, kept getting just an insatiable desire for more. They started going on margin, and then the common person all of a sudden gradually got enthralled as well, and FOMO took over. And then all of a sudden, to your point about, wow, this is now available to the masses, it's like everybody was not just buying stocks and speculating, but they were doing it on margin.
Yeah.
I mean, just a common person was buying margin, meaning borrowing money to invest in stocks, became commonplace.
To OPM.
Yeah.
Well, and the interesting
money.
thing is the amount of leverage that they used to extend, or what was customary, is that they would effectively loan you 80, 90 cents, on the
Sure.
So if you were going to buy $100 stock, you could put up maybe,
$10.
You could put up $10, borrow 90, and now they even talk about what the interest rates were for what they called call loans, right? Those were call loans, and people were paying 9%, 10%, 15% to borrow the money, but banks were so convicted that the market was going to be more valuable in the future that the certificates for these stocks, as they would have traded back then, where you would have gotten your certificates, that they were gold, that you would be willing to lend somebody 80, 90% of the purchase price, like it was a home, right? And that it wouldn't go down. And so that was it became common practice that you were going to borrow a lot of money to invest in the market, and it was going to allow you to buy a lot more shares than you were originally going to. So if I had $100 and I could buy a single share of RCA or DuPont or whatever it was, my broker would look at me foolishly if I said I'm going to buy one share for $100 when I could have bought 10 shares, right? With and $1,000 worth of purchasing power.
Yeah.
If I wanted the leverage, and that's what everybody was taking on.
Yeah. To your point about the certificates, another note that I took was a theme pervasive throughout the book is just that the infrastructure leading up into the crash really wasn't in place to handle this type of speculative, just the volume increase that they saw. And so you'd have days leading up until, when the actual crash happened where the exchanges couldn't catch up for days. They had, back.
You had very stale pricing.
Yeah, absolutely. Right? And it's to try to picture that in today's environment where you would go and place a trade in a well-known stock. I wanted to go, buy a share of whatever, and not knowing what the price of it would be it's just crazy to think about. But that was the reality leading up until that point. And so, one other note I took, just worth mentioning about the environment, is that the Fed was created essentially after the panic of 1907 and played a big role, and Andrew highlights that throughout his book. But many people at the time thought that the Fed was essentially a solution to the boom and bust that happened within the United States leading up until that point.
Yep.
And I think anybody would tell you since it's probably the exact opposite, where they might be the cause of some of the boom and bust. But if you also realize that the mentality of people going into 1929 was that we've got the Fed to backstop any problems that we have, or they might be able to step in as the lender of last resort, or whatever their mentality was. That informed a lot of the way that people behaved leading up until that point as well.
Well, and to that point, right, leading up into the actual crash, right, you had Herbert Hoover was elected, and those first, I guess, 2 years prior to that, the market started to actually show some signs of wobbling, right? And a little bit of volatility began, and there were some kind of scary days there or weeks there, and there was an actual growing narrative that this has gotten out of control. The speculative fever across the country was out of control, and there was a growing kind of view among some people in business and in banking and in government that the Fed should step in and actually raise the discount rates that were kind of the base rates for some of these call loans and all this, and that they needed to kind of do something to step in and kind of take the punch bowl away from the party a little bit, right? Slow things down so that this didn't get out of control. But then the big power brokers, the guys that were the real powerful people within Wall Street especially, they were like, no, we don't want this party to end. And so there was collusion going on among these guys, especially Charles Mitchell, the guy that ran National City Bank, and many others and like Durant, who was some of the big industrialists of the day. Durant that started Chrysler, started General Motors, all these guys that had made a ton of money, and they were very powerful. They started talking together about how we need to get somebody in there to influence the situation. And specifically, as Hoover was coming into office, we got to get him on board to kind of exert influence over the Fed to the extent that he maybe thought he could or they thought he could, to get the Fed on board with supporting the market, supporting the economy, not pushing against it, right? Which kind of sounds a little bit similar to some discussions today. So there was this view that, most people wanted the party to keep on going and knew that the extension of credit and keeping the cost of credit low was absolutely essential to keep that party going.
The nuance there is that from a regulatory standpoint or a planning standpoint, that you want to make sure that the system is functioning. You don't want to encourage too much speculation, right? They don't want the formation of bubbles.
Mm-hmm.
But what they also learned as a result of not really leaning in to help support things as they were crumbling is that you have to be willing to extend credit, and you've got to be a little easier with your policy when market conditions are deteriorating. And so, we've been evolving into this more managed economy for a while, right? The Fed was still a new animal at that point in time.
That's right.
But it still even had some more limited powers.
Mm-hmm.
And, so much has changed since the financial crisis in terms of what the Fed has the ability to do and the steps that they've taken to avoid another depression, which, interesting note that the term depression that we now reflect that was what dominated the economic environment in the 30s was something that Hoover actually termed.
Mm-hmm.
That
to try to make it sound better.
Well, he didn't want to say that there was a panic,
right?
And so he used this term depression,
right?
And thinking that maybe that would that was going to be softer to
right.
the ears,
right?
But now it continues to loom that's the worst of the economic downturns that we can be faced with, and we ended up having one really under his watch.
But what's interesting as well about the similarities between then and then, let's say, the late 90s internet bubble, the financial crisis that followed after the real estate bubble, and other types of lending bubbles that were occurring back during the 2005, 6, 7, up to 2008 timeframe. And then even today, starts with a fundamental basis for something, the environment being healthy.
Right.
And then it grows and grows and grows. But then it gets to this point where everybody en masse, the herd mentality takes over, and people become delusional, mm-hmm. where they, to your point you said earlier, the focus on risk management, the thought that this can go another way, there's another edge to this sword, kind of just gets lost, and everybody just gets caught up in the flurry of emotion and the promises of riches forever and all that. And the concept of thinking about things prudently and taking appropriate measures just gets thrown out the window.
Yeah. I would say that I think a lot of these environments, they start out around something novel. There's a technology boom.
Mm-hmm.
So in the 20s, it was radio,
yeah.
right? And then it was just mass production.
Yeah.
Okay. The availability of credit, but these things so it starts out in a good place, but it gets perverted by the excessive leverage
right.
that investors start taking on because they think this is a surefire.
Yep.
This is a surefire win, and why would I not borrow money
mm-hmm.
to be able to do more of this? So all these things there's a technology boom. There's an excessive amount of credit that gets used. Another thing that I thought was interesting in the book is that there always seemed to be, for the largest investors or players of the day, they're always creating some sort of an advantage for themselves.
Yep.
And so they talked about with Jesse Livermore and a number of these guys, they would have multiple telephones on their desk that were wired straight in to the exchange, to where they could pick up and they could pick up the phone, have somebody on the exchange tell them what the price of something was, and that was a comparative advantage for them because most people didn't have telephones, period, let alone something that was attached directly to the exchange. In the last 20 years or so with this high-frequency trading, we've seen where these guys they've actually had cables that are lined out in a shorter distance from one point to another.
Yeah.
So the information is going to travel a shorter distance.
So that part hasn't changed. Yeah.
That part hasn't changed, right? Yeah. It's the same. These folks are trying to create a comparative advantage for themselves by being on the forefront of implementing this technology into their space. But the one thing that they can't change is the human condition.
Yeah.
That the emotions that we feel, the greed, the anxiety, the fear, it is still the same today as it was back then.
It's probably a good setup for the question that we get from a lot of people. We talk about the book to clients, to friends, right? And the question that naturally everybody wants to ask is, could it happen again?
Yeah.
And, I think a good way to think about that is to look at some of the similarities and the differences between that time period and this time period. And, I wrote down a laundry list of things kind of on both sides of that and it becomes apparent as you read through the book, because certain things you read, you could literally be reading a headline from today.
Today, yeah, absolutely.
And then there's other things that you look at and you think to yourself, how did we ever get away with that? Or they were allowed to do that back then. So, like one example, right? 1929, the time leading up into it, the stock market was still a novel thing. I mean, it had been around for a long time, but in terms of the public perception of it, the broad use of it. So,
the democratization.
There you go. There's a word.
Yeah.
1929, they estimate roughly 10% of the American population invested in stocks.
Yeah.
That number today is probably about 60.
Yeah.
So the concept of investing in general really wasn't even a thing for most people.
You didn't have 401ks back then.
What was retirement? Retirement didn't exist in a lot of ways. And so people think about it entirely differently today than they did back then. So, that to me is a big difference. And so this was out of a lot of people's minds outside of the headlines that they saw. They weren't participating, although the people who wanted to were doing it in a meaningful way. Yeah. So
one of the things that I thought was interesting when we're talking similarities and differences, there are by some measures, we could definitely have another market crash in the future. Does it go down 90%? Probably not, because of some of the other things that are in place now that are protections for the system that were not available back then. But in the beginning of the book, as he's kind of setting the plot here, there's a scene where things are starting to get a little shaky, Chad, as you said. Some of the volatility started to creep in, well in advance of when the market actually collapsed. But as things were on shakier ground and there was some uncertainty going on, you've got everybody leaving their office and they're retreating to their homes, uptown in Manhattan. And as soon as these folks left the office, they were effectively turned off until the next day. And there's part of the story where he's hashing out maybe some notes that Charles Mitchell had written in his journal or things that he'd said to his wife, concerns and anxieties that he was harboring at that time. And if that were to happen today, there would be hundreds of text messages or emails that fly back and forth between whomever this concerned person is and the other person that they're desperate to talk to.
Right.
And so that is, I feel like, one of the main differences between then and now is how slow information moves, the fact that there were times where you were literally detached from even the things that you were concerned about and the anxiety that they felt around things that they really had to internalize until the next day or the next week, or
Sure.
where that doesn't happen today, right? You may have that anxiety present with you all the time, and you have the ability to try to hash something out and really not be able to separate from it.
Sure.
Well, and speaking of Charles Mitchell, I think one thing that we could kind of look at as a similarity that's beginning to creep in to today is when things were getting shaky then, in the building into the fall, October 29 timeframe, leading up to that, as this volatility was kind of developing and percolating, and you started to have some shots across the bow in the markets. A lot of the big primary players were getting concerned, and whenever there was a fall of any kind that was meaningful, and especially in the midst of the actual beginning of the decline in October, these primary bankers and primary larger players in the market that wielded such power in the markets were colluding, and like you would have a difference then versus today is that you had banks because of the Glass-Steagall Act, which we'll get into, but there was not a separation. There was not a Chinese wall separation between the investment bank and the commercial bank. So the banks back then, as they were getting larger and larger, they were deploying bank capital into the markets. They were making loans that were, that money was going into equity markets, or they were combining both operations of the business of the bank. But secondly, and so that's different today. But secondly, though, what was similar is this kind of circular kind of pattern that developed where you would have, the larger bank operators, some of the like J.P. Morgan and Lamont, who had influence there, and these other guys that ran these banks, they would call up their buddies who were their clients, the largest industrial, kind of billionaires of the day, and they'd say, "Hey, we're going to put together a pool." You mentioned it earlier. These essentially private pools, and they're going to collude their money together, creating almost like a little private mutual fund or hedge fund, just in the moment. And we're going to go buy, shares in this stock to support this stock
At a discount.
Right? And
Which
and
some
then,
of those things you read and you think to yourself, "Good Lord, like you
Right.
can't get away with that's
and
not
then-
legal." But
and
at
then,
the time, it wasn't.
But then they would begin to also lend to each other,
Right.
And then that lending became the way by which they would also support some stock. Well, compare it to today. We've been talking about this in some recent content we've been putting out about these larger companies like Oracle and OpenAI and NVIDIA and all these companies that they're beginning to, invest in each other. They're going to do business with each other. We're going to buy each other's products. We're also going to borrow to be able to make investment in this company or buy actually stock in this company. And you get into this kind of close-knit circular kind of thing where there's a lot of supporting of the stocks of the day that are the leadership, stocks of the day.
And those are the markers.
Going.
Those are the markers
Exactly.
that you're towards the end, right? Where you're having to fabricate the demand on your own. And so, the story here, about how National City, they were trying to buy the corn bank, and it was supposed to be an all stock sale, but National City Bank needed their stock to be above a certain price to be able to make it happen.
$4.50.
And Charles Mitchell knew that that it probably was not in the cards, but he knew that he needed to step in and put his own money on the line.
That was after they put the bank money in to buy their own stock, right,
and then,
to support it.
And then so when that didn't work, he went and basically leveraged everything that he could to buy stock in the bank.
And specifically also got a loan from J.P. Morgan.
Yes.
To do it.
To be able to make it happen. And he ended up, going from being one of the wealthiest people in the world to owing the bank millions of dollars.
Yeah.
So the point about manipulation being commonplace, I found really interesting. But the fact that these titans thought that it was their job, first of all, to go in and support the markets, right? It was their responsibility to do so. They felt that sense of responsibility, and then just the fact that they thought they actually could do it.
Yeah.
I mean, J.P. Morgan had done it, right? So after the panic in 1907, he stepped in and basically was the bid for the stock market, and it recovered. And so they went into 1929 with this mentality that if something like this happens again, that's our way out. We have to. That's our responsibility. We will do it. But by that point, it had grown too big for them to actually be effective doing something like that. But, that's a huge difference between then and today in that, it was a small group of people that had the power to do something like that had the wealth to do something like that, their wealth relative to the stock market. Today, there's no way, right? It's
just the ability to be able to inspire confidence, to engender confidence across the market, to where if J.P. Morgan thinks that the market is not going down and he's putting his money in, then I can be confident that maybe I should not be selling too.
Yep.
But confidence is a fickle thing. And so the thing that I was most moved by in the book, and that I think that would hit anybody reading it today, and it's a foreign feeling to us today because we've been in a market that has been moving higher for so long, largely uninterrupted. There have been some pullbacks in the market, but we haven't had a recession in this market. I mean, aside from the little blip in COVID, where we technically did have 2 quarters of consecutive GDP decline.
That's not the definition anymore.
Apparently not. Yeah, it was in 2020. In 2022, it was not. But so we technically haven't had a deep, meaningful recession since 2008, and I think that many people have forgotten what it's like to be scared. People have forgotten that guttural concern and anxiety that is pervasive in bad economic environments. And that was the shift, right? It was not the case during the Roaring 20s, but when things finally took a turn and that bubble burst, then there was a tremendous amount of pain.
Yeah.
And what kept this from just being a large drawdown is that confidence that people had in the market and in the economy, it soured and it bled into other areas of the market. So we talked about it last time, that what's the difference between a mania and a bubble? Because stock prices go up and down in both. But in the bubbles is when the bondholders get wiped out, or when people who perceive that they're not taking risk with their money, when they get wiped out. So as you were talking about, all of the banks, there were 30,000 banks, none of them federally chartered, all at the state level, some super small, very regional, very crop-centric, and there was zero deposit insurance. And so you could have your money at the bank, and if the bank went under, to quote South Park, poof, right? Your money's gone. And that started happening en masse as these banks were failing in late 29, but into 1930.
Yeah, a little bit of 32,
and 31.
33.
And
I think by 1932, there had been over 12,000 banks that had gone out of business in that 3-year period since.
The irony was you had Herbert Hoover was a Republican, and FDR was a Democrat from New York, and I found it very interesting that Andrew Ross Sorkin would kind of detail out that Hoover is not he's not revered in a positive way, but he talks about how even, before he became president, he was maybe one of the, greatest humanitarians.
Mm-hmm.
I think he says something along the lines of him being the most qualified to be president based on his resume up until that point.
Yeah, and that he had really worked to arrest a crisis in the early 1920s when he was Commerce Secretary, but that he did care for people,
Mm-hmm.
and he gets this negative image through the lens of history that he brought this on, or he was unwilling to help, but he was kind of caught politically between wanting to make sure that there weren't rampant excesses in the market, and that you've got to be able to have a little bit of an iron fist around, or you've got to be steadfast in that we're not going to allow certain things, but that because the markets and the economy had soured so much, and this was in late 29 going into 1930, 31, the presidential election was in 32.
Mm-hmm.
And he would have needed, so they lost the midterms badly in 1930, and where they would have needed support from both parties to be able to get some legislation out to really arrest the economic downturn, there was no desire for working across the aisle for collaboration.
They didn't. The new or the incoming administration didn't want to be tainted with the responsibility for any of what went on in the previous administration.
None of that is new, right?
No.
Because even today, it's, this outgoing president, he's not going to work with the new president, or the new president's not going to work with him. And as much as we could all get bent out of shape of watching when those transitions happen, that has been the case historically.
Yeah. It's interesting how he shines light on that period of time when FDR had already been elected, and of course Hoover was the lame duck president for that couple of month long period of time, but yet he was very concerned about how rapidly things were deteriorating, and he reached out to FDR and was pleading with him to basically say things, to outline what his policies were going to be, to try to instill some kind of level of confidence and clarity for the general public, because he was actually thinking that would be helpful.
Right.
And FDR was like basically just rebuking him, or just kind of just ignored him, and thought that he's just going to, even if it was going to go downhill even more swiftly, it was going to be all pinned on Hoover.
It's not going to happen until I get there. The other thing is that the inaugurations back then used to take place in March, and not January.
Longer lame duck session.
Yeah. And so, but the fact that Hoover did have this desire to be able to see things improve, and had some actionable ideas that the Roosevelt administration would end up implementing, but they didn't do it until Hoover was already out of office. Yeah.
So, I want to kind of circle back and focus on a little bit of the getting caught up in the environment of the moment kind of situation. So you think about these titans of industry, titans of banking, and the pillars of Wall Street, and of much of the economy itself in that time frame. A lot of the people are highlighted by Sorkin in the book, that they were incredibly shrewd business people, right? Very intelligent, highly revered, very wealthy. And one after another, they got caught up in this whole thing. They did various things to try to initially just really press on the gas in terms of leverage and borrow to try to get wealthier and wealthier. But then as it all came crumbling down, they believed in it so much, they didn't recognize the changing in the environment. They did the same, they went further. And then as a result, so many of these people, like, the thing about William Durant, right? This guy was one of the wealthiest guys in the world even. He started GM, he started Chrysler. He was very successful, many other businesses, got really successful as a investor and speculator, and he's just one of many who ended up by 1936 he was completely bankrupt, and he and his wife had to live out the rest of their days on like a small little pension that was basically a stipend that was given to them by kind of like it was arranged by the DuPont family, because he had a background with them.
It seems like there's a lot of stories like that.
Story after story after story, and it all goes back to, again, getting caught up in greed, getting caught up in over-leveraging people themselves. And I think the correlation to today, while fortunately there's not as much rampant borrowing of money to buy stocks, right? That is a different factor. There is still a lot of that going on.
There is a lot of leverage. There's a lot of leverage. It's just done in different ways now.
Correct. And but for someone to say, XYZ stock, let's just focus on the S&P 500, for example, and the large cap tech names that dominate it, the view is they will always go up. And let's just forget about let's toss risk management to the wind, and let's focus on, forget about diversification, and let's just concentrate further and further into that particular market leader name or market leaders, because they're going to keep going up.
Yeah.
And I think we got to recognize that the similarities that exist today to these other periods like that.
Yeah. There's, and a couple of other points related to that, the, international dollars were flowing into the U.S. the same way that they are today, right? The U.S. is the only place to invest, or has been for a long time.
Right.
Very similar to the situation leading up into 1929. The tech names being the tech names of the time, the RCAs, and to me that was an incredible similarity as you read through it. And the one thing that jumped out at me probably the most, which we haven't talked about, was the fact that leading into that point, the economy was doing really well.
Mm-hmm.
And you could make parallels to today, to where we've seen job growth, wage growth. We've seen blips along the way, but in general, the economy was doing pretty well. I mean, there was a couple of quotes that I pulled out from the end of the book where Robert Lamont, not Thomas, who was the Commerce Secretary at the time, was talking about that and this was 3/4 of the way through 1929, that year over year, the consumer purchasing of automobiles had been greater than the time period the year before.
Mm-hmm.
The sales of industrial products, pig iron, steel ingots, those types of things, were up 17+% over the previous year. So there were a lot of indicators that the economy itself was healthy.
Yep.
And it's tough to foresee something, terrible happening in the markets when the rest of the economy seems to be doing well.
But what investors have a very hard time, detaching themselves from, is the fact that even though the fundamentals can be good, what goodwill has actually been imputed into those stocks?
Yeah,
right.
What's been priced in,
and so that is the issue today.
Mm-hmm.
That a lot of the earnings releases that we're getting today from some of these leading technology companies, the growth that they're having in these different areas of their business, data center, whatever, is up 35-40%, year over year. It's incredible growth numbers, and their forecasts for where it's going is still very robust. But the market has been very recently selling those stocks almost indiscriminately, and I've seen commentators come on and make excuses to try to say it's irrational that these things would sell off because the fundamentals are so good and the companies are giving this guidance. But there is an information asymmetry here that all investors need to be aware of, that the market is going to perceive things or know things that we don't. And perhaps the growth numbers right now are very robust, but that doesn't mean that they have to be that way a couple of years from now.
Yeah. So if to that point, it goes to the point of what's been priced in, the level of expectations that have been built into the valuations of the market today are at such a level that if anything doesn't go perfectly, swimmingly, then that perfection, that's been priced into the market, all of a sudden is the catalyst that brings a change, and then from there it can become a herd going the opposite direction. So real quick on that, you and I mentioned that we did a little spot on the Buffett indicator a couple months ago. Here's a quick little update, right? The Buffett indicator, which for those that don't know, is looking at the value of the stock market relative to the total GDP output, right? So it's equivalent to a price to earnings ratio for a stock, but it's the price to earnings ratio for the entire stock market relative to the economy, right? Right now, the highest level ever in history, for the record, at 230%. So that means that the stock market is priced at 130% greater than the value of the GDP, of the total output of the U.S. economy, right? And the average, we're like way beyond the average. We're 2.5 standard deviations above the average. So the point is, the economy looks pretty good right now in many ways, but the pricing of the market has been to perfection. And if it doesn't stay that way in just the slightest way, then the ice is really thin and it could give way.
So when Larry McDonald came on the $1 Million Question a few weeks back, he made a comment on there that I thought was very telling, that a lot of the AI names that have dominated the market and the growth of those securities over the last couple of years, he said the market is pricing in that in the next 5 years that we're going to build 825 data centers. He said if that number just turns out to be 600, then a lot of these stocks could fall by, he thought, 50% or more.
Staggering.
And it's staggering. And, Larry told me a number of years ago when the energy stocks were getting pounded and nobody wanted to buy energy stocks because oil was just going to go lower and lower. He told me that the most money that you ever make in the market is when a sector of the market goes from uninvestable to simply really bad. That the delta that happens there, it's uninvestable and then it's really bad. You don't see a way out, but it's not uninvestable anymore. That there is a massive rally that happens between that point and that point. The other side of the coin is that there can be an incredible amount of money that is lost when things go from exceptional to really good. And I think that is a concern for this market today, that our market, the S&P, has never been less diversified than it is now. And the amount of goodwill that is imputed on a lot of these names, if things do not go swimmingly well, if there's any hiccup, then there is a lot of risk there, and I think a lot of folks are starting to pay the price for it right now.
Yep. So it's good for us to be students of history, right? We want to understand the correlations and the similarities, and hopefully learn from so much of what has been good and bad in the past, and not repeat.
Yeah, and I'll say this as far as one of the takeaways that I had, and this is, it's not anything about structurally about the way that the market is set up now or regulations that we have today that we didn't have then, but it's a more like personal conviction side of this, and that is that when I read through this book, and as somebody who's studied the market and market history and economics for years, a lot of the names in this book I didn't know. But these were people that were titans of industry at the time. Charles Mitchell, right? I had no idea who Charles Mitchell was going into this, but he was, I think you alluded to, Chad, he was a rock star. He was revered in the culture at that time, and was once one of the wealthiest men in the world, and ended up effectively a pauper. And his name, if Andrew Ross Sorkin doesn't pin it in this book, just goes quietly into the annals of history. And so we need to understand that the name and our legacies that we create, they're a lot more fleeting than we think that they are. And that we really need to make sure that we're building into our families and into the communities as much as we can, because ultimately, even as important as we think we are in the time that we live, we will eventually be forgotten.
Well said.
That was well said. That was pretty deep, actually, Stephen.
So I thought that was one of the strong takeaways that I had there. So, Mike, any final thoughts?
I mean, it's interesting to me, having spent a ton of time in the management of large wealth management, Wall Street type firms, that to see all of the things that came out of this, all the regulation, the FDIC coverage, the SEC, the Glass-Steagall Act, the fiduciary standard, right, that we talk about, every one of our clients asks about today, all of that came out of this. And so, there's always lessons to be learned. And a lot of what I took out of this was that the markets and how we act in the markets and the behaviors changed as a result of that. So that happens every time. Same thing happened in 2008.
Yep.
Same thing happened every crash before that. And so, it could happen again. It probably will happen again at some point, and we'll be better for it.
Well, they always try to put on governors, to prevent the prior crash from happening that was not on there before the prior crash happened. So it always
invariably causes the next one.
Yeah,
right?
Yeah.
It's going to happen a little differently the next time. But look, market risk will always exist. We are never going to be able to eliminate it from the system. The human condition is going to have these things persist, and there will be excesses, and we have to make sure that we are regulating ourselves if we're going to protect ourselves from any future market crash that happens, because we know it is inevitable. It may not take the exact shape of the ones that we've seen recently, but they will happen. So
yeah, and having an adaptable approach to being able to deal with come what may is important, right?
100%.
Being mindful of the environment and being able to adapt and navigate appropriately is important.
100%. All right. Well, thanks both of you for joining us for this discussion. Thank you, everybody, for tuning in. We will see you here next time on Bugle Notes. Take care.